Sofi reported fiscal 2023 first quarter earnings on May 1st, and the stock price fell as a result. In this video, I'm going to review SoFi's latest earnings results and answer if that stock price fall was justified or if the market is overreacting to the news. So let's begin. What you could see here is a chart of SoFi's stock price from April 26th to May 2nd. You could see SoFi was trading right around $6 per share, a little bit above $6 per share before earnings came out, and the stock price fell all the way down to $4.83. So for a stock at trading at such a low price, that's a significant decline. In fact, if we could look at the percentage change, that's a 16% fall um, from the where it was on April 26th, but a much higher fall if we look at from where it was before earnings. It was up more than 10% since April 26th before earnings came out, and then now it's down 16%. So from top to bottom, a 26% fall. And part of this can be explained through, if when you see the stock price rising so much before earnings come out, that tells you the market is optimistic about the earnings that are about to be released. And so that creates a level of expectation that this company is going to deliver good earnings. And then when the earnings are not up to the level the market expects, it causes an even bigger decrease in the stock price because it was built up going into the earnings report. So I'm going to talk about what happened in the quarter. SoFi Technologies reporting fiscal 2023 first quarter earnings results. So let's get into the actual figures. Total net revenue increased by 43% to 472 million. The net loss improved to 34.4 million. This was up from a loss of 110 million in the same quarter the prior year. So far, excellent news. And SoFi management has forecasted that by the fourth quarter of this year, they will be profitable on the bottom line. So they are making good progress towards that target of being profitable on the bottom line. Total members grew 46% year over year to 5.7 million. That was an increase of 433,000 from the previous quarter. Investors were a little bit concerned how SoFi's members would react through all of this volatility in the banking sector. You might recall there was several bank failures in the quarter. People were fearing about the safety of their deposits in banks, and they were moving their funds out of these smaller banks into the bigger banks like Bank of America and JP Morgan. So there was some concern how SoFi stock would do throughout that disruption, and they did relatively well. That said, SoFi's rate of customer growth has slowed for 7 straight quarters. 7 straight quarters. So the rate of growth is decreasing even though they're still growing. Okay. Here's the part that starts to, I think, explain why SoFi's stock was down so much. The loans the company's making. Personal loans of 2.95 billion in Q1 was up from 2 billion year over year, so they're making way more personal loans. Home loans of 89.8 million was down from 312.4 million from the same time the year before, and school loans of 525 million was down from 983 million. Of course, school loans are impacted by the federal moratorium, and the Supreme Court is still waiting to release its decision on the forgiveness of student loans. So let me break down each of these. So personal loans are the most risky of all loans because when you enter an economic downturn, if a consumer has a home loan, a car loan, a student loan, and a personal loan, and they lose their job or they see and experience a decrease in income, the first loan that they're going to stop repaying is personal loan. Because if they stop repaying their personal loan, the consequences are less severe. If you Because if you stop paying your home loan, if you stop paying your mortgage, your home can be foreclosed on and you could lose your house. So that's the last thing you're going to stop repaying, right? And if you stop paying your car loan, your car can be repossessed. So that's the next to last thing you're going to stop repaying. Student loans, you might stop repaying or you might call and try and get a deferment and all of that. So those are a little bit more risky, but at least student loans cannot be discharged in the event of bankruptcy. So at least there's that to, SoFi has that going for it. But personal loans, if you stop repaying your personal loans, your credit's going to be hurt, yes, but your car's not going to be repossessed, your home's not going to be foreclosed on. So if you find yourself in a bind, that's the first thing you're going to stop paying back. And that said, the risk of that is even higher now that the potential for a recession is increasing with every month that goes on in 2023. The Federal Reserve has continued raising interest rates. That's slowing economic activity. And so we're approaching a severe economic slowdown. Additionally, personal loans make up 9.6 billion of the 22.45 billion in total assets for SoFi. So I'm going to show you their selected balance sheet information. If you look here, personal loans 9.6 billion, and these are loans held for sale. Personal loans 9.6 billion of their total loans of 16.2 billion. So the vast majority of loans on SoFi's balance sheet are personal loans, and these are loans for sale. Another risk is as the Federal Reserve has increased interest rates, it decreases the value of these loans. Decreases the value of these loans. So if SoFi was to try to sell these loans to third-party investors, they would have to sell them at much lower prices now that the Federal Reserve has raised interest rates significantly, and they are going to raise interest rates, expectations are, this week again. So that's the riskiness here with the bank. You're not just looking at revenue and profits. That's important. That is important, right? That shouldn't be ignored. But you're also looking at the quality of the balance sheet, which for banks is more important than in any other kind of investment, arguably. And the quality of SoFi's balance sheet this quarter deteriorated. It just took on a higher percentage of personal loans. The balance sheet now has more personal loans, and with interest rates rising and the fears of an economic recession, the company overall just became more risky just because of the greater portion of personal loans. And it doesn't help that the banking industry is under severe strain. We've had several banks fail already in 2023. And bank stocks, as of this recording, several regional bank stocks were down 30% or more today. So the pressure on bank stocks has not eased, even though JP Morgan rescued First Republic Bank over the weekend, buying it out of receivership. That has not stopped all of the problems. So even though SoFi, and they're raising 2023 guidance to 29% revenue growth up from the previous target of 27.5%. Yeah, that's good news. But, you're making money off of giving these very risky loans. So what's the sustainability of that business model? That's what investors have been concerned about. And, to answer the question I posed in the headline, yes, it is justified that SoFi's stock price would fall after the results of this quarter. Given the turmoil in the banking sector, given the riskiness of the loans that it made in the quarter, it's understandable that investors would shy away from SoFi stock given the level of risk. All right, so that's all I've got for this video. If you enjoyed this, please subscribe. I've got deeper dives coming out for SoFi's earnings. I'm going to go through the conference call. I'm going to go through deeper and provide more analysis. So if that's something that you might be interested in, go ahead and subscribe. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.